I need to tell you something that's been keeping me up at night. And I'm not someone who loses sleep easily, but what I'm seeing right now, what the data is showing us, what's happening behind closed doors in Silicon Valley and Washington and boardrooms across America, it's terrifying. We are standing at the edge of the most devastating economic collapse since 1929, and almost nobody is talking about it. The signs are everywhere. The warnings are flashing red. And yet, the majority of investors, the everyday people who have their life savings in the market, they have no idea what's coming. By the end of 2026, potentially as early as the second quarter, we're going to witness a stock market crash so severe that it will redefine wealth in America for the next generation. I'm not talking about a correction. I'm not talking about a bear market. I'm talking about a complete structural breakdown of the systems we've relied on for decades. And here's what nobody is telling you. This crash is already in motion. The dominoes are already falling. We just can't see them yet. Let me be very clear about something from the start. I don't make predictions like this lightly. I don't traffic in fear or sensationalism. Everything I'm about to share with you is based on patterns, data points, economic signals, and conversations with some of the smartest people in finance, technology, and policy. These are people who saw 2008 coming. These are people who correctly predicted the dot-com bubble. And right now, they're more worried than I've ever seen them. So if you're watching this, if you're listening to these words, I need you to understand that the next 30 minutes could be the most important half hour you spend this year. Because what's coming isn't just going to affect the wealthy. It's not just going to hit Wall Street. This is going to touch every single person who has a retirement account, who owns a home, who has a job, who participates in the economy in any way. And the people who understand what's happening, who prepare for it, who position themselves correctly, they're not just going to survive this. They're going to thrive. While everyone else is panicking, losing everything they've worked for, the prepared few will be positioned to build generational wealth. So let's start with the most obvious question. Why 2026? Why am I so certain about this timeline? Because we're watching a perfect storm of factors converge, and the math is brutally simple once you see it. First, understand that we're living in the longest period of artificial economic stimulus in human history. Since 2008, since the financial crisis, central banks around the world have been pumping unprecedented amounts of money into the system. They dropped interest rates to zero. They printed trillions of dollars. They bought assets on a scale that would have been unthinkable to previous generations. And it worked for a while. It kept the economy afloat. It kept markets going up. But here's what most people don't understand. That wasn't real growth. That was monetary morphine. We took the patient who was dying, and instead of doing the hard surgery, instead of fixing the underlying problems, we just kept giving them more and more painkillers. And now, that patient is addicted. The economy is addicted to cheap money. Markets are addicted to stimulus. And like any addiction, when you try to take it away, withdrawal is catastrophic. Right now, we're in the withdrawal phase. Interest rates have gone up faster than almost any time in history. The Federal Reserve, central banks globally, they realized they created an inflation monster, and they're trying desperately to put it back in the cage. But here's the problem. You can't just turn off a decade and a half of stimulus without consequences. Every time rates go up, it's like tightening a noose around the economy. Companies that were profitable at 0% interest rates suddenly can't service their debt at 5% rates. Businesses that were valued at 100 times earnings when money was free suddenly look insanely overvalued when bonds are paying competitive returns. Real estate that made sense when mortgages were at 3% becomes unaffordable at 7%. The entire structure of the economy was built on a foundation of free money, and we're watching that foundation crumble in real time. But the interest rate problem is just the first domino. Let me tell you about what's happening with artificial intelligence, because this is where things get really disturbing, and it's something I think about every single day. We are on the verge of the most rapid technological displacement of human labor in history. And I'm not talking about some distant future. I'm talking about right now. The AI systems being developed today, the ones that are about to be deployed at scale over the next 18 to 24 months, they're going to eliminate jobs at a pace that will make the Industrial Revolution look gentle. We're talking about radiologists, lawyers, accountants, customer service representatives, truck drivers, riders, programmers, even some doctors. Entire professions that employ millions of people are about to become partially or fully automated, and the market hasn't priced this in yet. Companies are trading at valuations that assume continued consumer spending, continued employment, continued economic growth. But what happens when unemployment doesn't go up by 1 or 2%? What happens when it goes up by 10 or 15% over a very short period? What happens when tens of millions of people suddenly realize their skills are obsolete? History gives us a very clear answer to that question. When large populations suddenly lose their economic utility, when people can't find work, when they can't pay their bills, consumer spending collapses. And consumer spending is 70% of the American economy. If consumption drops by even 20%, we're looking at a depression, not a recession. The stock market, which is essentially a bet on future corporate earnings, will have to reprice violently downward because those earnings are about to fall off a cliff. Companies that are valued as if they're going to grow 20% a year will suddenly be shrinking. And when the market realizes this, when it really sinks in, the selling will be panic-driven and indiscriminate. We'll see trillion-dollar companies lose half their value in weeks. We'll see retirement accounts decimated. We'll see margin calls triggering forced selling, which triggers more margin calls in a death spiral. I've seen it before, but this time will be worse because the scale is so much larger. Now let's talk about corporate debt, because this is the hidden bomb that almost nobody is discussing. American companies, especially in technology, but really across all sectors, have taken on absolutely staggering amounts of debt over the last 15 years. Why? Because money was basically free. When you can borrow at 2% or 3%, it makes sense to take on debt to buy back your own stock, to make acquisitions, to fund operations. And that's exactly what companies did. Corporate debt in America is now over $12 trillion. That's trillion with a T. And much of that debt was issued at low rates that are now expiring. Companies are going to have to refinance this debt at rates that are double or triple what they were paying. For many companies, that means their interest payments will exceed their operating income. They'll be technically insolvent. And when companies start defaulting on their debt, when bankruptcy filings start accelerating, the credit markets seize up. Banks stop lending. Businesses can't make payroll. The whole system grinds to a halt. And here's where it gets even more insidious. So much of this corporate debt has been packaged into complex financial instruments, derivatives, collateralized loan obligations, the same kind of financial engineering that caused the 2008 crisis. Except this time, the pile is bigger. The leverage is higher. The interconnections are more complex. When this starts to unwind, it's going to be virtually impossible for regulators to contain. They'll try, they'll throw money at it, but the hole is too big. We borrowed from our future for 15 years, and now the bill is coming due, and it's going to be devastating. Then there's the geopolitical layer, which adds accelerant to an already raging fire. The global order that's existed since World War II is fracturing in real time. We're seeing the emergence of competing power blocks. Trade relationships that seem stable are dissolving. Supply chains that companies spent decades optimizing are breaking. The era of cheap goods from China, of predictable global commerce, of American dollar hegemony, that era is ending. And markets hate uncertainty. They hate instability. When companies can't predict their costs, when they can't rely on their suppliers, when geopolitical tensions threaten to disrupt business at any moment, valuations compress, growth slows. And in a world where stocks are priced for perfection, where companies trade at multiples that assume everything will go right, any disruption is catastrophic. We're not talking about one or two disruptions. We're talking about systemic fragmentation of the global economic system. And that's happening right now, accelerating every month. Let me give you some specific numbers because I want you to understand just how stretched the market is right now. The S&P 500, as of this moment, is trading at a price-to-earnings ratio that's in the top 95th percentile historically. That means stocks have been this expensive only 5% of the time in the entire history of the market. And those previous peaks, every single one of them, was followed by a massive correction. In 1929, in 2000, and 2007, the pattern is identical. Valuations detach completely from fundamentals. Everyone believes this time is different, and then reality reasserts itself with brutal efficiency. The euphoria turns to panic literally overnight. And the people who didn't see it coming, who believe the narrative that stocks only go up, they lose everything. Their retirement plans, their college funds, their dreams, all of it evaporates in a matter of weeks. Here's another number that should terrify you. Margin debt. That's money that investors have borrowed to buy stocks. It's currently at near record highs. People are so confident, so certain that the market will keep going up, that they're borrowing money to amplify their bets. This is the classic sign of a market top. When taxi drivers and dentists are leveraging up to buy stocks, when everyone from your neighbor to your cousin is giving you investment advice, that's when you know we're at the end. Because when the market turns, all that margin debt becomes a weapon of mass destruction. Investors get margin calls. They're forced to sell. That selling pushes prices down, which triggers more margin calls, which forces more selling. It's a feedback loop that feeds on itself. And in a market this leveraged, this extended, this overvalued, that cascade can happen with shocking speed. We could see 20%, 30% declines in a matter of weeks, not months or years. Let's talk about what happened the last few times we saw conditions like this. In 1929, the market lost 89% of its value from peak to trough. People who were millionaires in September were broke by 1932. Entire fortunes, built over lifetimes, were wiped out. Suicides were common. Families lost their homes. Banks failed. Businesses collapsed. It took 25 years for the market to recover to its 1929 highs. 25 years. Think about that. If you were 40 years old at the peak, you were 65 before you got back to even, assuming you didn't panic sell, assuming you held on through the entire nightmare. In 2000, during the dot-com crash, the NASDAQ lost 78% of its value. Companies that were worth billions became worthless overnight. Again, it took 15 years to recover. In 2008, the S&P fell 57%. People lost their homes, their jobs, their retirement savings. The recovery took years, and even then, millions of people never fully recovered. They had to push back retirement. They had to lower their standard of living. Their entire life trajectory changed. And here's what I need you to understand. The crash that's coming in 2026 has the potential to be worse than all of those. Why? Because we've never had this combination of factors all converging at once. We've never had this level of global debt. We've never had technological displacement happening this rapidly. We've never had markets this overvalued for this long. We've never had the kind of monetary stimulus withdrawal we're experiencing now. We've never had geopolitical fragmentation at this scale. Every single risk factor is elevated simultaneously. It's like the perfect storm, except instead of 3 weather systems converging, we have 10, and the resulting devastation will be proportional to the unprecedented nature of the convergence. Now, I know what some of you are thinking. You're thinking, people have been predicting crashes forever. The market has always recovered. This is just fear-mongering. And I understand that skepticism. There are always perma-bears predicting doom. But here's the difference. I'm not predicting that the market will eventually crash someday, somehow, for some reason. I'm identifying specific, measurable factors that are happening right now, showing you the timeline, explaining the mechanism of failure. This isn't vague. This isn't abstract. The interest rate shock is real and measurable. The corporate debt refinancing cliff is on the calendar. The AI displacement is already beginning. The geopolitical tensions are in the headlines every day. The valuation metrics are objectively extreme. These aren't predictions. These are observations of current conditions. And those conditions are unstable. They can't persist. Something has to give. And when it gives, it's going to give catastrophically. Let me also address the idea that the government or the Federal Reserve will just step in and save everything again like they did in 2008 and 2020. I understand why people believe that. They've seen it happen. The Fed prints money, buys assets, backstops everything, and the crisis gets averted. But here's what's different this time. Inflation. In 2008, there was no inflation. In 2020, inflation hadn't arrived yet. The Fed could print with impunity. They could expand their balance sheet by trillions without consequence. But now, we just went through the highest inflation in 40 years. It's still not fully under control. If the Fed tries to respond to a market crash by printing trillions again, inflation will explode. We could see 1970s-style stagflation or worse. We could see the dollar lose its reserve currency status. We could see a complete breakdown of the monetary system. The Fed knows this. They're trapped. If they don't intervene, markets crash. If they do intervene, the currency collapses. There's no good option. They're playing a game where every move leads to checkmate, and that means they can't save us this time. We're on our own. So what does this actually look like when it happens? How does a crash of this magnitude unfold? Let me walk you through the likely sequence because understanding this will help you prepare. It starts with a catalyst. Maybe it's a major corporate bankruptcy, a company everyone thought was safe suddenly failing under the weight of its debt. Maybe it's a geopolitical event, a conflict that disrupts trade in a critical way. Maybe it's an AI announcement that makes it clear millions of jobs are about to disappear. The specific trigger doesn't matter as much as the underlying conditions. When the system is this unstable, anything can be the spark. In the first days after the catalyst, you'll see sharp selling. The market will drop 5%, then 10%. The media will call it a correction. Analysts will tell everyone it's a buying opportunity. And some people will believe them. They'll buy the dip, like they've been trained to do for the last 15 years. But this dip won't bounce. It'll keep dipping. By the end of the first week, panic will start to set in. The market will be down 20%. Portfolios that were worth millions will have lost hundreds of thousands. Retirement accounts will be bleeding, and the news will start to cascade. Companies will announce layoffs. Earnings will be slashed. Credit downgrades will accelerate. The narrative will shift from temporary correction to serious downturn. By week 2 or 3, we'll be in full capitulation mode. Hedge funds will be unwinding positions. Algorithmic trading will amplify the selling. Margin calls will force even long-term investors to sell. The market could be down 30% or 40% from the peak. At this point, fear will be universal. Everyone will be talking about it. The news will be wall-to-wall coverage, and the psychological damage will be severe. People will feel paralyzed. They won't know whether to sell and cut their losses or hold and hope for recovery. Then comes the really dangerous phase, the credit crunch. As stock prices collapse, banks and lenders get nervous. They tighten lending standards. Companies that need to roll over debt find they can't. Bankruptcies start. First, it's the weak companies, the ones that were barely surviving anyway. But then it spreads to larger firms. Companies that employ thousands of people. And with each bankruptcy, with each round of layoffs, consumer spending contracts further. Earnings fall more. Stock prices fall more. The cycle feeds on itself. We could easily see the market down 50% or 60% within 6 months of the initial catalyst. And unlike previous crashes, the recovery won't be quick because the underlying economy will be fundamentally damaged. It's not just a liquidity crisis this time, it's a solvency crisis. It's a structural crisis. Now, here's what I really want to emphasize. This isn't about timing the market perfectly. I can't tell you if this starts in March of 2026 or September of 2026. I can't tell you if the market drops 50% or 70%. Those specific details are unpredictable. What I can tell you with high confidence is that the conditions for a severe crash are present, they're building, and they're unsustainable. And more importantly, I can tell you what you need to do to protect yourself and potentially profit from what's coming. Because here's the thing, crashes are devastating for the unprepared, but they're opportunities of a lifetime for those who see them coming. So let's talk about strategy. First and most important, liquidity. Cash is going to be king. I know that sounds counterintuitive. People have been told for years that holding cash is stupid, that inflation erodes it, that you need to be invested to build wealth. And in normal times, that's true. These aren't normal times. When assets are collapsing in value, when stocks are down 50%, when real estate is cratering, cash is the most valuable thing you can have. It gives you options. It gives you the ability to buy incredible assets at a fraction of their worth. It gives you safety. You need to be building cash reserves right now, not next year, not when you see the crash starting, right now, because by the time everyone realizes what's happening, it'll be too late. The selling will be indiscriminate. You won't be able to get out at good prices. How much cash? At least 6 months of expenses, ideally a year or more. I'm not saying sell everything and go to 100% cash, but if you're 90% invested right now, you're taking an insane risk. You should be looking at your portfolio and asking yourself, what would happen if this lost half its value? Could I survive financially, emotionally? If the answer is no, you need to de-risk immediately. Sell some of your stocks, especially the speculative ones, the unprofitable tech companies, the meme stocks, anything that's trading purely on narrative rather than fundamentals. Take those gains or cut those losses and move to cash or very short-term treasury bills. Second strategy, focus on quality. If you're going to remain invested in stocks and there are reasons to maintain some exposure, focus obsessively on quality. That means companies with strong balance sheets, low debt, consistent profitability, real pricing power, and essential products or services. Think companies that people need, not companies that people want. Food, energy, healthcare, utilities. Boring businesses with boring but reliable cash flows. These companies will get hit too in a broad market crash, but they'll survive and recover. The speculative growth stocks, the ones trading at 100 times sales, they might not survive at all. A lot of them will go to zero. So if you're holding those, seriously consider whether the risk is worth it. Third strategy, consider alternatives. Gold has been a store of value for thousands of years. In times of currency instability, in times of crisis, gold holds its value. I'm not saying put everything in gold, but having some allocation, maybe 5% to 10% of your portfolio, provides insurance. When paper assets are collapsing, when people lose faith in the currency, gold is what they flee to. Similarly, think about real assets, not overpriced real estate in bubble markets, but productive assets. Farmland, for example, energy infrastructure, things that generate real value regardless of what's happening in financial markets. Fourth strategy, prepare for opportunity. This is crucial. The best investments of your life, the ones that generate generational wealth, happen during crashes. Warren Buffett made his fortune by being greedy when others were fearful. In 2009, you could buy blue chip stocks for a fraction of their intrinsic value. Real estate in some markets was 70% off peak prices. The people who had cash and courage in 2009 became very, very wealthy. The same opportunity is coming, but you have to be ready. You have to have the capital available, and you have to have the emotional fortitude to buy when everyone else is panicking. That's why you're watching this video right now. You're preparing yourself mentally and strategically for what's coming. When the crash happens, while everyone else is paralyzed by fear, you'll be executing a plan. Let me also talk about what not to do, because this is where people make fatal mistakes. Do not try to short the market unless you're extremely sophisticated and understand the risks. Yes, you can make money betting against stocks, but the timing is nearly impossible, and you can lose everything if you're wrong. The market can stay irrational longer than you can stay solvent. Do not panic. Sell at the bottom. This is the most common mistake. People hold on as the market falls 20%, 30%, 40%, and then right at the bottom, when the pain is unbearable, they sell. They lock in their losses at the worst possible moment, and then they miss the recovery. If you're going to sell, do it now, before the crash, while prices are still high. If you don't sell now, then have the discipline to hold through the bottom and into the recovery. Do not go into debt right now. This is critical. If you have variable rate debt, refinance to fixed if you can. If you have credit card debt, pay it off. If you're thinking about taking out a big loan for a car or a house or a business, really think hard about whether now is the time. Because if we hit a recession or depression, if you lose your job or your income drops, that debt will be an anchor that drowns you. The people who do worst in crashes are those with high debt and low liquidity. The people who do best are those with low debt and high liquidity. Be in the second category. I also want to talk about the psychological aspect of this, because it's going to be incredibly difficult. Even if you know intellectually that a crash is coming, even if you've prepared, living through it will be brutal. You'll wake up every day to headlines about how much wealth was destroyed. Your friends and family will be scared and angry. There will be constant pressure to do something, to react, to try to fix it. You'll second guess every decision. When you're holding cash and the market is still going up before the crash, you'll feel stupid. When the crash starts and you didn't sell everything, you'll feel stupid. When you buy near the bottom but it keeps going down, you'll feel stupid. This is normal. This is part of the process. The key is to have a plan now before your emotions are running high, and then to stick to that plan with discipline. Write down your strategy. Write down your rules. When I'll sell, when I'll buy, how much I'll keep in cash, and then follow it, regardless of how you feel in the moment. One more thing I want to emphasize. This is not just about protecting your money. It's about protecting your life, your mental health, your relationships. Financial stress destroys marriages. It destroys health. It destroys happiness. The people who are most financially stressed during the coming crisis will suffer in every dimension of their lives. So when I'm telling you to prepare, I'm not just talking about investment strategy. I'm talking about building resilience. That means having an emergency fund. It means having skills that are valuable regardless of what happens to the economy. It means building strong relationships with family and community. It means taking care of your physical and mental health. Because when things get hard, and they will get hard, those are the things that will sustain you. Let me tell you something else that's crucial. You need to be very careful about who you listen to in the months ahead. There will be no shortage of people telling you that everything is fine, that the market is strong, that you should keep buying. Many of these people are financially incentivized to keep you invested. Brokers make money when you trade. Fund managers make money on assets under management. Media companies make money from advertisers who want optimistic content. There's a huge infrastructure designed to keep you bullish, to keep you buying, regardless of the actual conditions. You need to be skeptical. You need to think independently. Look at the data yourself. Ask hard questions. When someone tells you the market looks good, ask them, how do you explain corporate debt levels? How do you explain valuation ratios? How do you explain the AI displacement that's coming? If they don't have good answers, don't listen to them. And finally, I want to leave you with this thought. What's coming is terrible, but it's also necessary. We built an economy on unsustainable foundations. We borrowed from the future. We created inequality on a scale that's historically dangerous. We allowed financial engineering to replace real productivity. We let technology advance without thinking about the social implications. All of these chickens are coming home to roost. The crash is the correction. It's painful, but it's the reset that allows us to rebuild on more sustainable foundations. On the other side of this crisis, there will be opportunity to create a better system. There will be chances to build real wealth based on real value. And there will be space for innovation and entrepreneurship that actually improves lives rather than just extracting value. So yes, 2026 is going to be devastating for many people. The crash is coming. The warning signs are everywhere. But if you prepare now, if you position yourself correctly, if you maintain discipline and courage when others are panicking, you can not only survive, but thrive. You can protect your family. You can seize opportunities. You can be part of building what comes next. That's why I'm sharing this with you today. Not to scare you, though the reality is scary, but to empower you, to give you the information and framework you need to navigate what's coming. Because knowledge is power. Preparation is power. And in times of crisis, the prepared few will determine the shape of the future.